someone who is financially rich is an owner. They're not a consumer. They're a consumer also. But when somebody is poor, they're a consumer. That all they do is they take the, I always tell people we're all financial traders. A lot of people say, I'm not a financial trader. Yes, you are. You're trading time for money. Yeah. That's the worst trade you can ever make in your life. Somebody who's wealthy has made money their slave. They're no longer the slave to money. And the way they do that is they figured out how to become an owner. And the way you do that in the most simplistic way, I even taught it in my first book, was you have to decide there's a percentage of money that you're going to keep forever. You're not going to give it to Kate Spade or Ferrari or anybody else. You can do that too. But there's a percentage of that income that never will be touched, that you will grow and compound and will provide income the rest of your life so you don't have to work. Now, when I was growing up, everybody's goal was get rich enough so you never have to work. Now, like all my friends are 15, 18 years my senior. People like Steve Wynn and most of Las Vegas, he's like 74. Warren Buffett's 85. Peter Gruber, one of my dearest friends in the world, owns the Golden State Warriors, the LA Dodgers. We're partners in the LAFC football team in LA. Brilliant guy, 74 years old. And they're all working harder now than they ever were, and they don't have to work. So the goal is make enough money so you don't have to work, and then you'll do what you love, and you'll pour your time and energy into it. But you have to make that decision. It's the first most important decision is I'm going to become an owner of American business. You don't want to have an Apple phone and not own Apple. And you don't want to just own Apple because any company can go up and down, right? You want to own the index. You want to own, a variety with enough diversification. But if you can just shift, and I've taught people who've told me they have no money, they can't save. It's really easy once you get momentum. There's a research project I did with a gentleman who was nominated for Nobel Prize on behavioral finance. And what he did was he said, if you can even, you need to save 15% ideally. But if you could even save 3%, because anybody can do that. They took a group of blue collar workers in the Midwest and said, we're going to force you to save 3%. I think it was 3.25 or 3.5. Everybody can go on a diet tomorrow. Everybody can save money tomorrow, right? Yeah. So his tool was, all right, you're not going to save today, you're going to save tomorrow. We'll do the 3.5%, but then you go to your employer and say, the next time I get a raise, the first 5% goes to my savings account, to my investing account. And then every time you get a raise, you do that. Well, in 14 years, the average person was saving 15%, and the top 40% were saving 20%. Now, let me explain what that means. You and I were together before. When I'm trying to explain compounding to people, everybody understands it intellectually. But when I ask some of the richest people in the world, what are most investors failing to do? And they all say they're not tapping the power of compounding. So if you're in a situation where, as an example, let's take, you've got $100,000 that you've saved, you're 35 years old, and you put it in the market and just leave it there and never add anything to it. If you leave it in the market and you're only being charged 1% in fees, at retirement 35 years later, you got $762,000 from that 100. Never added a dime, it grew that much. Wow. But if you pay 3% in fees, which is the average most people are paying, when you ask people what they're paying, they don't know, or they say 1%. Because when you hear about fees, let's say a mutual fund fee, you'll always hear 1%. That's the expense ratio. There are 17 other fees. So every 1% you overpay, 1% is the average. But if you pay 2 or 3, and the average mutual fund is 3.12, sounds like nothing, 1 or 2%. But every 1% you overpay because of compounding means you lose a decade of income. So the person who paid 1% has $762,000. The person who paid 3% has $452,000, and they own the same stocks. It's just fees. So while we compound our interest, we also compound fees. So if you could save 3% and build it to 5, 10, 15, or you start with 10 or 15 and eventually get to 20, the best example I can give your viewers is that there's a gentleman who worked for UPS who literally never made more than $14,000 a year. You heard about him in the book. And when he retired, he had $70 million. Crazy. And he gave away $35 million while he was alive. And the reason was, a friend of his set him aside and said, look, I'm gonna make you rich. He goes, I'm never gonna be rich. I make 14 grand a year. He goes, I'm gonna make you rich. I'm gonna make you rich later in life, and I'm gonna do it by a 20% tax to your business. And he goes, I make $14,000 a year. I can't live on 20% less. And his friend said to him, if the IRS came and said a 20% more tax, you'd scream, you'd yell, and you'd pay it. And he said, but we're gonna pay it for you. And that 20% compounded generated $70 million. So for the people that are at home, the sooner you start, the better off you are, because compounding does it. I've got an example in the book of a guy that starts at 19. He puts aside $300 a month. He stops at 27. So he does it for 8 years. He only puts in, I think it was $35,000. But It's $1 million by leaving in the market when he turned 65 and he stopped at 28. He has a best friend that starts at 28, invests his entire life, puts in $180,000, and he has less money at the end. The sooner you start, the better you are.
That's what I'm here.
Well, in the book I explain you've got to have diversification.
Right.
And what most people do is they go to a mutual fund and they think it sounds logical. I'm no good at this. This is not my skill, a person says. You go to a professional who runs a mutual fund, what do? They figure out a series of investments to make, they put it in the fund and they do it for you. And you think, well, gosh, they're smarter than I am, they'll do well. You assume that, but the truth is they charge so much that even if they did have an advantage, they lose it. I interviewed David Swenson, who's the head of chief investment officer at Yale. It took Yale 200 years to get $1 billion that they saved. He turned it into $25 billion in 2 decades.
Wow.
It's unheard of. He's the greatest institutional investor of all time. And one of the things that he told me, he said, Tony, you just got to understand something. He said, you're never going to earn your way to wealth. He said, how many people have you seen, movie stars, actors, athletes? The other day, 50 Cent just went broke, right? He made $100 million on vitamin water alone. Somebody gave him a tipping, and he had half a billion dollars, and he's broke, completely broke. Mike Tyson made $500 million and went broke. You can understand that a little bit. Elton John didn't go bankrupt because it's different rules in England, but he got in trouble. Who I just saw the other day is, what's his name? The Pirates of the Caribbean. What's his name?
Johnny Depp?
Johnny Depp. Yeah. Johnny Depp's going bankrupt right now.
Really?
Johnny Depp.
He's making like 20, 30 million a year.
Yeah, Johnny Depp was worth $700 million, $750 million. He's on the verge of bankruptcy right now, can't pay his bills. He was paying $30,000 a month on wine alone, right?
My gosh.
He spent $3 million to take Hunter Thompson's body, burn it, put the dust into this giant cannon and shoot his dust into space, $3 million. It doesn't matter how much money you earn, you can always get rid of it and lose it. Buy an island and watch how quick it disappears.
Yeah,
right?
exactly.
So what I show people is, what you really want to do is create an income for life without working. The goal, if you own a business, and I would assume a lot of your viewers are business owners or getting started in business, no matter how good you are in business, think about this. The one universal rule that idiots in finance know is diversification. It's the only free lunch. You got to diversify. Because if you put all your eggs in one basket, no matter how good the basket is, one day that real estate market, that stock market, that bond market, that collectibles market, whatever you invest in, Ray Dalio showed me statistically, it'll drop 50 to 70% on a day. Now, if you're later in life and that happens, it's over for you.
Right.
So you have to diversify, and yet most people, they know real estate, so they do it, or they know stocks, so they do it, or they grew up with their parents flipping things, and it's the wrong thing to do. So you've got to diversify in order for you to be able to truly succeed, and that's why when you own a business, if you put all your money in your business, which is what most of us do naturally,
a lot of risk.
You put all your eggs in one basket, and there's things that can happen. I mean, let's say you spent 20 years and you figured out how to put together the ultimate map, and you remember Garmin came out with this thing called the TomTom. I don't know if you remember, you used to put on your, are you old enough to remember that? You used to put on your phone? Or you used to put on your dash? Cost $100. It was a breakthrough.
They were making like 100 million or something.
They were. 6 months later, what happened?
The iPhone came out with Google Maps.
These little bastards, excuse my French, came out with it, put Google Maps, put their own map on here, and it costs how much? $0. What's that going to do to your business when someone takes your product or service and gives it away for free? So I always tell people, competition happens, technology happens. What you must do is have a second business with no moving parts, no people, no time. Maybe it takes you 2-3 days a year for 2 or 3 hours after you've read the book. You put it in place and you measure it 2 or 3 times a year. That's it. Go on with your life. Now, if there's a trouble in your business, you're financially set. In my life, I have 31 companies now. We have, what do we have? 1,200 employees, 7 different industries. We do $5 billion in sales. I mean, that used to be, me and my seminar business. It's grown geometrically. But with all those moving parts, the only way I've been able to succeed is because I've taken every one of those businesses and I've diversified my assets so that when things were in trouble, I still have enough economics to take care of myself and keep the business going. So everybody needs to create a money machine that works while you sleep, that doesn't have moving parts, and that's what this is really about. Teaching people that winter is coming. We all know winter's coming, right, to coin a phrase. But that winter is the best time on earth. And I know that's counterintuitive, and I don't mean like being a positive thinker. I mean pure facts. So in the book, I take you through 10 facts. I'll give you a couple of them right now. The first fact I give people is, why do people not invest? They're afraid of failing. If you're a millennial, right? So you grew up witnessing 2008 and you're watching the world melting down in front of you. Yeah. For most millennials, they are the first generation since the generation that went through the Depression that is not investing at the ratio they need to, even close. President Obama just paid off his debt 5 years ago while he was still president.
No.
I swear to God.
Oh my gosh.
It's mind-boggling. And he had a bunch of scholarships, but the last bit, it took him that long. So what I tell them is, listen, paying off your debt's not enough. You've got to become an owner or you're always going to be in that place. So yes, pay off your debt, but here's what you need to know. You got to become an owner. You got to get in the game, but you got to understand the rules of the game. If you don't know the rules of the game, the old phrase is, when a person with experience meets a person with money, we know the phrase, the person with money ends up with the experience, the person with experience ends up with your money, right?
Yeah.
So I teach people the rules of the game so they don't get screwed. But the most important thing is this. Winter's coming, but people react. So let's take last year. Last January, 2016, we had the worst stock market opening in the history of the stock market. First, I think it was 10 days. Yeah. There was a drop of $2.3 trillion with a T.
Crazy.
Everybody's freaking thinking the bear market's here, the market's over, the crash is here. I think the market dropped 800 points one day, and on that day, all the richest people in the world were in Davos, Switzerland, for the big conference that they do every year. And they went there, MSNBC went there, and everybody's freaking, what are we gonna do? And they said, let's go ask Ray Dalio. Now, your listeners may or may not know Ray Dalio as, if you're not in the financial business, probably never heard of him. You probably heard of Warren Buffett, but Ray Dalio's done more. You had to have a $5 billion net worth and $100 million to give him, or he wouldn't talk to you 10 years ago. Now, he doesn't give a shit how much money you have, he won't talk to you, because he's got a closed fund. But they go and they put Dalio on television, CNBC, he's the king. What do we do? And he says, well, you don't need to panic. Corrections happen all the time, but you need a strategy that when markets go up and down, you don't go up and down. And he said, I spent 15 years of my life to perfect such a strategy. All of my money's in that plan. And he said, it's called All Seasons, and I've never revealed it before, but I gave it to Tony Robbins. He extracted from me, and it's his book. So you got to go read his book. That's what he says on national television the day the markets are crashing. And that day, to give you an idea, the market was down 9% in the first 5 weeks of the year. His strategy, which he gave me, which has made money 85% of the time for the last 75 years. Wow. It's averaged a 10% return, just under, and the average loss, when at 15% loss, was 1.6. Right. So if you go to Vegas and you could spend 85% of the time make money, and when you made money it was 10%, your loss is 1.6, you go forever. His plan made 2% while the market was down 9%. So it was up 11% difference. Now, I'm not suggesting that's the only strategy to do. There's many. His is the smoothest ride with the least risk. But what it did was, combination of that, and then right after that, I interviewed Fed Chair Alan Greenspan. He was the head of our economy, the most powerful man in finance for 19 years, 4 presidents. He was there running. I was just with President Clinton this last week. He was the Fed chair for him. And I interviewed him for like 2 hours, or 3 hours off stage, 2 hours in front. And I asked him in the very beginning of this thing, I said to him, I said, look, if you could be put in the Fed today, what would you do? And he looks at me, and as I said, he leans forward and he says, resign. So here's what will free you. Everybody's afraid of the crash. So here's what you need to know, 2 terms you should understand. Correction versus crash. Anytime the market drops from its high by 10% or more up to 20, it's called a correction. Right. If it drops 20% or more up to 80%, like in the Great Depression, then it's called a crash or called a bear market. Okay. So how often does a correction happen? How often do we have to be prepared for it? Since 1900, we've had a correction on average every year for 116 years. So when is winter coming? This year on average. It's like, how often does winter come? You wouldn't be surprised if it stormed and rained. Now, some winters are long, some are short, some are harsh, some are light, but winter always comes. So I wasn't panicked when this happened last year. I'm not panicked whenever it happens because I know it's supposed to be. Yeah. How long does it last? Average, 56 days. Okay, so just under 2 months. What's the average drop during that time? 14% over the last 30 years, 13.5 over the last 100 years. So I use the more recent one. 14% gets your attention, right? 14% you get a little gut check. Yeah. But here's what you need to know. 80% of all corrections never become a bear market. 80%. So all this fear, and what people do is what you said you did, is they see it, it's freaking out, I'm losing money, I'm the hell out of here, and they get out. The stock market never took a dime from anybody, only you can take it from you. You sold, that's why you lost.
Right.
So if you look back and say, what was it like in 2008? I can remember vividly being with my platinum partners and saying, you see these $80 stocks? This is 6 months before the crash. I told them in April, I brought them to Dubai and I said, these stocks are gonna go to 8 and some are gonna go to $1. Wow. And by October, and I told them what to do, so they were able to get out. October, I go on the Today Show in October of 2008 and they go, Tony, there's been $3 trillion meltdown. Pump the country up. You got 4 minutes. like,
ready to go.
That's not what I do, first of all. And I said, that'd be a lie. I'm not going to pump up. At that point, the $80 stocks were 8. I said, some of those, I said, I'm not a market forecaster, but I work with Paul Tudor Jones, one of the greatest investors in the history of the world. In the biggest market crash in history, 1987, he made 200%.
Wow.
When everybody else was losing their entire life. I've been coaching him continuously now for 24 years, every single day. Wow. So I said, I work with the best in the world. And they're telling me based on history in the 30s and history in the 70s, this $8 stock, some are gonna be $1. And I remember the day in March of 2009, Citibank, which had been, I think, $70, sold for 97 cents. You could go and take your money out of the ATM. It costs you more to take your money out than to own the bank, right? And then I told people it'll jump from 99 cents to $6, $10, $12 in a month or two, and it's exactly what it did, right? So what you gotta know is corrections happen every year. You gotta know they're a couple months, you gotta know it's 14%, and you won't lose because 80% of the time it doesn't go to a bear. Now, what about the bear? The bear market, it happens, to give you an idea, in the last 100 years, every 3 to 5 years. We've gone 8 without one. We're way overdue. So in modern years, last 30 years, it's about every 5 years. The average length of a bear is 1 year. The average drop is 33%.
Wow.
A third of those drops go 40% or above. That, I don't care how well prepared you are, that's a scary thing. But it is the greatest opportunity in your lifetime to go from wherever you are financially to where you want to be. I hope your audience is listening right now. Hear me. If you want to leapfrog and you're a millennial and you think there's no future, or you're, a baby boomer and you think you're too old and it's too late, the greatest gift you have is coming. I know it doesn't sound like it. This is not positive thinking bullshit. This is the truth. Wall Street, the stock market, is the only place that when things go on sale, people freak out. If I said, you like Ferraris?
Sure.
If I said to you, Ferraris go on sale for 50% off.
Awesome.
But when I tell you Apple's on sale for 50% off, you go, oh, what am I gonna do here? What's wrong? The whole world's coming to an end. So let's assume if you were 35 and you lived to 85, you got 50, 52 years ahead of you. That means you have 52 more corrections to live through.
Right.
That means you're probably in those 50 years gonna have 10 more bear markets to live through. If you're gonna have a gut checks every time, or you're gonna leave out of it, if you didn't participate because you thought, oh, the market's too volatile, I can't trust it, all that stuff, you missed 250% return in the last 8 years. I mean, you've missed out on everything while you're waiting for things to be better. And if you won't do it when it's like this, when it crashes, you're not gonna get in. So here's the good news about the bear. The good news about the bear, average ones a year. Could be longer, but that's the average. Could be shorter. But here's what's cool. Every single bear market in the history of the United States has led to a bull market, meaning right afterwards. So 2008, this plummeting, what happened in 2009? Up 67% in a year. I can show you every single bear market, and the next year when it comes out, it's this explosion. Now that's not true in every market in the world. It's true for 2 centuries in the United States. So that's why Warren Buffett says, I want to be greedy when people are afraid. And I want to be afraid when people are greedy. If you remember 2008, he was telling everybody, buy. He was having the time of his life. Buy, everything's on sale. So what you have to do to become unshakable is the metaphor I use is turn the snake into the rope. Meaning, we all know the story. It's the middle of the night. You're walking through the yard or someplace and you see a snake and you're freaked out. You pull back, you come in the morning and it's a rope. Once you know it's a rope, you're never afraid again.